Hey guys, how's everyone doing? Brand new year, let's kick it off by discussing various different options for investing. First, I'm going to divide these into two sections. The first section being stock market investments. And real quick, just stock market here really means is any market you can access digitally or yourself with a broker primarily. So let's see. First one, of course, being stocks. Stocks, as I walked through in our last video, represents the underlying company. Stocks here I refer to individual stock picking, where you can invest by choosing individual stocks or individual companies. Next up is bonds. Bonds are one of the more secure investments you can make. However, the drawback is very low reward, sometimes not even keeping up with inflation. But bonds, of course, also depends on who you buy the bonds from, meaning the issuing entity. Bonds could be government bonds, company bonds from various different companies, different country bonds. The riskier the issuing company or issuing entity is, the riskier the bond. But if usually when you speak about bonds, people look for the safer government or municipality bonds, or very, very old companies with great reputations. So that's really where the safety comes in. Next up, ETFs. ETFs stand for Exchange Traded Funds, which is a fund that you can purchase just like a stock. Within the fund, it usually owns assets within its niche. However, ETFs can range from foreign market stocks to US only to small caps to real estate, commodities, anything in between. These funds do have fees charged by the fund's manager. Next one here, mutual funds. So these are similar to ETFs except for the fact that you usually have higher expense ratios or fees with mutual funds. And these funds are utilized more for investing accounts where you pay for someone to manage for you. So usually your investing advisor invests in various mutual funds, with each mutual fund having their own fund manager taking a commission to manage their fund. So pretty much this is the typical vehicle that if you go to the bank or your investment broker, these are what they usually use, the highest cost out of everything. And we're going to talk next about index funds. The recently popular fund that everyone is talking about. This is a fund that tracks an index such as a VOO, which is a Vanguard fund and tracks the S&P 500 index with a 0.03% expense ratio, which might be the lowest expense ratio of any fund. But compare that to an expense ratio that reaches into the 1 to 2% range, if not higher, which is usually found with mutual funds or different combinations of mutual fund and an investment advisor. The reason index funds are so low on fees is because the fund manager is simply copying the index that it tracks, versus a mutual fund manager or an ETF manager is a lot more active day to day on managing their fund or week to week, and they don't have anything to copy and they have to do all the research themselves. These funds can then also be purchased via a self-directed account, limiting your expense down to the fund's fees itself. And what that really means is instead of having your advisor, your investing advisor, having to do the purchase of an index fund, you have to pay the advisor and then you have to pay the index fund. You can just have a self-directed brokerage account, self-directed retirement account. I'll make a future video about self-directed as well. But once you have that account, you can just directly buy the index fund, and that is really what's the most recommended. So in addition to this, there's also this notion, this idea that the mutual funds, not all, but quite a few of them, do struggle to keep up with the general market. Why not invest in the market itself And with savings they save, because you're not investing in a high cost fund, with compounding effect, it is massive what you can receive over the long term. It's so incredible actually that I think the next video I do is going to talk about the compounding effect, because I believe that really gets people into investing early on, because you start seeing the time is the most valuable. With that being said, don't forget to subscribe and hit the bell so you can get notified of those 2 future videos. Now moving on. Next up is REITs, or real estate investment trusts. These trusts you are able to purchase just like a stock. However, these REITs are specifically heavily invested in real estate, and use your investment in them to invest in real estate. By being classified as a REIT, they are required to pay out 90% to its shareholders. So most of these you will find that have a huge dividend yield compared to the general market or compared to general stocks. Next up, commodities, commodity ETFs specifically. You can invest in gold, which is GLD, silver, natural gas, oil, corn, and any other commodity. Here you are purchasing an ETF that holds the underlying commodity asset. Next up, currencies. Through a foreign exchange enabled brokerage account, you are able to buy different currencies, currency pairs from different countries. And next, let's take a look at other investments that are not stock market related. First thing to note, most of these are much more capital intensive to get started. The first one being private business. When a company is public, you can invest in it via its publicly traded stock. However, if it is still private, you're not able to do that easily, but it is possible through different methods. The top 3 methods that I believe being A, having a boatload of money to qualify as an accredited investor and be allowed to invest early on through connections or right before an IPO completes. And if you don't have boatloads of money, well, we still got 2 other options here. So option B, start up a business yourself, build it from the ground up, and now you own shares in your company. Many of the richest people in the world get there through the massive appreciation of their own shares of their own companies, such as Jeff Bezos, Mark Zuckerberg with Amazon, and then with Facebook, and many others. And option C, if not everyone is inclined to start a business and it is a massive, it can be massively stressful. So if you don't want to start your own business, no problem. There's still another way to get an investment stake in a private business with no money needed. Find a business you really love and see massive potential for the future, and where it is still a startup, and get a job at that company with the opportunity of earning shares of that company by being a part of it in the early stages. No money required, sweat equity. That's what people call sweat equity. That one was a long one, so let's jump to the next one. Next up, real estate, probably the most popular, second to stocks maybe. Within real estate, you have a massive amount of options to make money through wholesaling, contract lease options, and various other methods. But the few that I consider more of an investment type are 1, rental real estate, where you purchase a property to rent out and receive some extra monthly income, or 2, developments, which you would take a lot of money or expertise, but this investment would all allow for large quantities of rentals, such as apartment complexes, malls, etc., usually commercial. And last but not least, undervalued buying. This is a lot more similar to my approach with stocks, but with real estate, undervalued buying, where you purchase a property that is very undervalued and you can, in a short amount of time, flip it for a good profit. And next up, Uh, and this is the last one here. This is usually called stored value assets, which is physical commodities, gold, silver, platinum. So, but pretty much the idea is this is a stored value that you can hide in and keep. Real estate is also a type of stored value. However, you're building on real estate. So land would be more of a stored value. However, again, it fluctuates depending on location, depending on what's going on in that area. And if you have a house, it depreciates and it loses value because of age, wear and tear. Gold and physical commodities, the idea here differentiates them amongst anyone else because primarily the actual asset does not change. It is always the same. It will always be the same. The only thing that changes is the dollar that is associated with that asset. So that brings us to the end. Thank you guys for watching. I hope this video was very helpful for you guys. If you liked the video, don't forget to like. And next video will be the compounding effect analysis. Comment down below if you have anything you would want me to mention in that video. And subscribe and hit the bell icon so you get notified. See you guys next time.